Well, look, central banks have a policy that is driven by doing what is right for the economy. And we always, as central banks, had to do that job under the permanent commentary of markets, of policymakers. And central banks will do what is right for the economy. In particular, the US economy and the US central bank is very data-driven. I think the mood noise around their policy will not deter them from doing what is right for the US economy. And actually, if you look at the strengths of the US economy at the moment, their measured rate hikes over the last few quarters are actually the right policy that the US economy needs. Inflation is on target. They don't need to bring inflation down, so they can take their time. They can stabilize inflation at the level where it is now. And I think the kind of rate hikes they mapped out for the remainder of the year, one more, maybe three more next year, looks roughly right for a former central banker like myself. It seems to be on track, in line with how the US economy is moving. Should there be a soft spot, and I think there is quite a risk that the current trade discussion will lead to some soft spot in the US economy in the fourth quarter, maybe going into the first quarter of next year, they will react to those weaker data. I don't think they will necessarily call off the rate hikes, but it might have an impact on timing. And so I think they will be data dependent and do what is the right thing for the US economy, independent of comments.
Here we are in Bali at this IMF meeting. We've heard the IMF and the World Bank knocking down the growth forecasts, raising concerns about financial stability. And then, of course, we had a bit of a market event overnight with this sell-off. And that's starting to create this idea that we may be in the last innings for this bull run. How do you see it?
Well, look, when I was in Davos, the mood in the market was overly optimistic. I was one of the few that was saying, the mood in the market is too good to be true, so it's probably not true. The market has corrected sizably since the early start of the year in Davos this year. I think when I look at the markets now, people are on the other side. They are too pessimistic in my view. We probably still will have a good year to 2 years for the global economy. The US economy is doing very strongly. It's tracking at around 3.5% growth at this moment, record employment levels. Inflation on target. I think the earnings seasons will be more muted than maybe in the heydays of financial markets, but the market still got some room to improve. So we're still overweight equity. The worst thing you can do now is get out of the markets. What you should do is be diversified. You should spread your investments because certain market segments like emerging markets are correcting stronger than others. So diversification is key of what you need to do now, not a sell-off, because I think the market is too pessimistic about the short-term outlook. Medium to longer term, I think the economy is still in a fairly good, I don't think we'll see a recession. We see a leveling off of growth. We're in the late cycle, it's very clear, but it's not going to lead to a major recession. It's going to lead to some sideward movements at worst for the economy, probably around some good momentum for the major economies. The weaker spots at the moment are the emerging markets.
The emerging market story is fascinating here because I think people reflect back to the Greenspan era, and of course we had a market event in the 90s and then Greenspan reacted, and then people now say, okay, maybe he fueled the dot-com bubble ultimately later. They're asking themselves, is Jay Powell the kind of Fed governor who would pause in that rate cycle plan if we get increased external pressure from something like a drop in demand in emerging markets, or, as you point out, a soft spot in the US growth rates around trade? So you feel that Jay Powell would be prepared to step in and say, no, we'll miss the fourth quarter hike, but we will reflect and review running into 2019?
It's a possibility because one of the things you see at the moment is that unlike the Fed at the time when Greenspan was there, the current Fed doesn't need to correct an overshoot of inflation above the target. They need to stabilize inflation around target, and you can see that. Headline inflation is at target, core inflation is somewhat lower because we've recently had an increase in oil prices, and that is shown in headline figures. It'll be washed out of headline figures. So the central bank can afford to take a slower tightening cycle than they have in the past because inflation does not threaten to overshoot target, but it is at target. And stabilizing it around target is an easier task than bringing inflation back down again. And the same is true in Europe. Europe inflation isn't even at target. Headline inflation is heading up, but core inflation is at 1%. So even if the US continues to take measured steps towards normalizing monetary policy at the global level is still as expansionary as it has been. And even in the US, financial market conditions are still fairly expansionary. So I'm not concerned that monetary policy will derail the global economy. You know, these type of expansions don't die of old age. They basically counter some headwinds in the economy. And whilst there are some headwinds, I don't think this is forcing a gale storm. This will be, in my view, a slowing down of growth momentum in a late cycle. It will not lead to a major kickback for the economy. And when I see what markets are pricing, these are really already extreme scenarios that, in my view, are not mapped in the data and most likely will not materialize.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.